Dad. I just want to kind of give you a little basics of stuff of why I'm doing what I'm doing with your portfolios. What this white line shows is basically interest rates. This goes all the way back to World War II, all the way back into the 40s. Kind of a crazy time with all that, obviously. And if you can see, we had about 40 years, topped up in 81 right here, about 40 years of increasing interest rates. During that time period, tangible assets, gold, silver, oil, all that stuff outperformed the high-flying, risky, growth-oriented stocks that like, obviously, lower interest rates. And then we saw a paradigm change in the 80s. And for the next 40 years, basically the entirety of my adult life has been in a decreasing interest rate environment, which commodities, for the most part, and value stocks do not perform well in. We have some outliers and stuff like that, the 2000, all that kind of stuff, when we had like a mini commodity bubble. But the big one was here, and then there was also one further back in the 20s after the Great Depression. But if you can see, we go up 40 years, down 40 years. It's not always perfect. And then we had COVID, major world event, paradigm change. You can see just some of these moving averages. It's basically a 200-day is the yellow and the 50-day. You can kind of see a similar pattern where they're crossing and moving into an actual uptrend for interest rates. So that's going to impact all these high-flying growth stocks because they do not like higher interest rates. The commodities and real tangible assets are what really do well in this environment. This lower pink chart is, it's actually just silver price through time, starting all the way back in 1913. And you can see, as these interest rates start going up here, what happens to the price? Well, first of all, let's say interest rates coming down, this silver is just moving sideways. So this is a very good indicator of what happens in it. It's not going to be perfect, but boom, hits, whoop, what do we go up? We went up. And then we're having low interest rates. This is called a consolidation pattern. Boom, boom. It's called a cup and handle. It's a technical chart pattern that probability is that it breaks higher. And this is basically 40 years of consolidation. So if this thing starts breaking out of this line right here above here, it's not going to be good for probably a lot of things, but my gosh, if you have commodities, silver, etc., it will set you up so you can kind of battle a lot of the inflation. These are inflation adjusted assets that basically do well to combat. It kind of offsets all your loss of purchasing power in the dollar. So another chart here, which kind of does it as the SPY, it's just SPS over time. And you can see silver, same thing. You can see commodities. It's a bull market here. S&P went sideways. Bull market commodities, this SPX went sideways for years. In 2020, had a mini one. S&P went sideways, well, commodities outperformed again, and it looks very similar in this pattern here. I just copied basically this and put it here. And just a general sense, it's not going to be perfect, but that's what I think is going to basically happen, where the S&P will kind of just chop sideways while commodities continue to outperform. So that's why I am starting to get you into some of these. Wish I knew this back in 2020 because that was the cheapest time to buy commodities since basically the late 60s. But now we're still very undervalued in commodities based against S&P, other indicators and stuff like that. You can't use the dollar to value things if you're looking to invest because the dollar just depreciates in value through inflation, and that's basically the system they've created. So We just got to live in it and just make the most of it and try to make the best decisions. And that's what I'm trying to do for you. So hope this helps. Love you.